What's up, everybody? Welcome to another episode of the Stock Bros podcast. My name is Tony, and today I'm going to talk about one of the most reliable, highly rated, and reputable high growth ETFs on the market today. And before we get started, please remember to subscribe, leave a like, check out my links in the video description below if you want to get started with investing. I have two great apps down there, Acorns and Public. If you sign up for Public, you get a free stock. And if you sign up with Acorns, you get $5 invested into your account, as well as check out my link to Udemy, the course I created for Financial Literacy and Investing 101 to help you get started as a new investor. If you don't understand stock market terminology or the fundamentals of investing, that's a perfect course for you to check out. So let's get started. Today I'm going to talk about QQQ. And for those of you that follow me, you know that I talk a lot about VOO and I'm big on ETFs that track the S&P 500. Well, QQQ is a perfect ETF to add to your portfolio to nicely complement VOO because QQQ is highly focused around growth. Now, what is QQQ? QQQ is an ETF that can be traded just like a stock. It's a bundle of stocks sold in one fund, and companies that make up this fund are companies that are listed on the United States' second largest stock exchange, the NASDAQ. The NASDAQ is one of the three major indexes that are used to measure the performance and the health of the United States stock market. So the three indexes that you have are the Dow Jones, the S&P 500, and the NASDAQ. So QQQ gives you access to the NASDAQ's 100 largest companies in a single fund. It's a very tech-heavy fund, and it focuses on non-financial companies. Now, QQQ was created in 1999 by a company called Invesco, and it's made up of over 102 companies, or I think it's exactly 102 companies. So as of April of this year, QQQ is the second most traded ETF in the US based on average daily trade volume. And also, QQQ is rated by Lipper as the best performing large cap growth fund over the last decade. So over the last decade, this was rated as the best large cap growth fund that you can buy. Now, if you were to put $10,000 into QQQ 10 years ago, today that would be worth $62,000. So in comparison, if you were to put $10,000 10 years ago into the S&P 500, today that would be worth $36,000. So you'd basically be doubling the S&P 500. Now, the thing to remember is obviously the S&P 500 is made up of 500 different companies over many different sectors of the market, and QQQ is made up of 100 companies, and these are large companies in the US that are very tech heavy. So the S&P 500 is more diversified with growth and value stocks, and QQQ is geared more towards a growth focus. And obviously, QQQ has been around since 1999, so it does have a long track record of success, but the S&P 500 has been around for almost 90 years. Now, let's talk about prices. So QQQ is currently trading around $330 per share, and I know that sounds really expensive, and I know you're probably thinking, well, it's great that 10 years ago, I put $10,000 in and it's this price now, but I don't have $10,000 to put in. Well, that's completely fine because you can use a strategy called dollar cost averaging. Now, if you were to put $100 a week into QQQ, just by starting off with $100 and you put $100 a week into QQQ for 10 years, that would net you a total of $166,000 in 10 years. And it's as simple as putting $100 a week. Now, obviously, you may not even be able to afford $100 a week. Maybe you could do $50 a week. Well, $50 a week would be still very successful as well. I haven't done the math on that, but I do know that I'll throw this chart up on the screen. if you were to invest $100 a week for 10 years, with the average return that QQQ has been giving over the last 10 years, you would have a very substantial amount of money in just 10 years. Now, QQQ has an expense ratio. All ETFs have expense ratios, and the expense ratio for QQQ is 0.20. This means that for every $10,000 you invest, you'll pay $20 per year. So every $10,000 invested per year, you'll be charged $20 per year. So this is very cheap, and the fee is actually built into the price of the ETF, so you won't even notice it. There's not going to be any deduction out of your bank account or checking account. You won't see this money come out. It's built into the price of the ETF, and QQQ is passively managed. So every quarter, the companies in the fund will be reviewed. And if there are companies that are underperforming for a certain amount of time, they will be replaced. And the top companies can be shuffled quite often. So hopefully this gives you a really good understanding of what QQQ is and why I feel this is a really good growth stock or ETF to add to your portfolio. And I know you may be thinking, well, this ETF has a lot of the same companies that are in VOO, so I don't understand what the difference is. And that's a really good question. So VOO tracks companies across all of the stock exchanges in the US, and VOO is made up of 500 companies. So it has some large cap and mid cap companies. It's 500 of the largest companies in the US. QQQ focuses on strictly companies listed on the NASDAQ stock exchange. And the entire goal of this ETF is centered around growth, high growth. So it is a good addition to your portfolio, and you can add QQQ alongside VOO, even though some of the top holdings in those ETFs are the same. And nowadays, Apple, Microsoft, Tesla, Facebook, those companies are going to be in every single ETF. So you have to go and you have to look at all of the companies, not just the top 10, even though the top 10 are the most heavily weighted companies. So anyways, that's one of my favorite picks for a growth ETF. Some of the other ones that people like too are VOOG, VUG, SPYG. I actually had SPYG in my portfolio for a long time, and last week I decided to sell off SPYG, and I did take a position into QQQ. I only put about $2,000 in it right now, but I am going to start dollar cost averaging into QQQ every single week going forward. I might throw $25, $50, $75 a week, whatever I can afford. I like to dollar cost average into several different ETFs every week. So that's going to be my strategy going forward. Not saying that you need to do this particular strategy, and everyone should try to figure out their own strategy and what works for them. And of course, as always, all investments include risk, even QQQ. And the thing about QQQ is because it focuses on high growth, there is going to be more volatility in QQQ than you would typically see in an S&P 500 ETF. You may see it fluctuate a little bit more because it's so heavy into growth stocks. So that's something to keep in mind. But it's all about the long term and it's all about the future. I don't get caught up in weekly or monthly results. It's all about years out. And if you invest with that mindset, and you don't worry about short-term volatility and you just stick to your plan. So anyways, thanks for listening. Thanks for watching. Thank you for subscribing. I appreciate the support. And until next time, thank you.